Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we'll talk about our top 10 potential surprises for 2024 and look back at what we said about 2023.
And feel free to tell us what's on your mind by emailing us at feedback@investorhour.com. All that and more right now on the Stansberry Investor Hour. All right, well, it's time to talk about last year and this year and what would surprise the heck out of investors. And that's what we do here. That's what this exercise is. We are not making 10 predictions. We are simply making a list of 10 things that would surprise investors based on where the markets are right now. So if the market is screaming higher, it would surprise people that it would fall. And if the market is plummeting, it would surprise people that it would scream higher, that kind of thing. And we look around at all different markets and just different parts of the world that might influence the market, including politics and other things. And we make a list at the end of each year of the things that would potentially surprise the heck out of most investors. Well, here we are once again, amigo. It's just about the end of another year. I don't know about you, but I turned 62 this year, and this year flew by. I mean, it's just...
Yeah, they're all going pretty quick. These last 5 years for me have gone very quickly. Ever since the pandemic, when it seemed time condensed, and then seems like it stayed that way. So
yeah, well, now that we've established that we're both getting old, maybe we'll take a look back at 2023 first and just kind of quickly run through the 10 surprises and whether or not they happened. The first one was, we said it would surprise investors for the S&P 500 just to have a normal return for 2023, like, plus 10% or something like that. And that surprise didn't happen, simply put. As you and I speak, we're up about 25% on the S&P 500 and 43% on the NASDAQ. So no surprise there. The surprise did not happen.
Yeah, I was looking back at what we said last year too, and I think I said that 2023 might not be as bad as people imagine and have slight gains for the year. Remember, there was the same kind of discussion or talk out there in the market about where we have now about the recession fears and everything, and it didn't seem like anybody was expecting, any positive returns at all. And then, yeah, like you said, outperformed what you would call average this year. So, did catch a lot of people by surprise. That part, a normal year did not. A outperforming year did.
Right. So number two was also like about the S&P 500, but it was a different surprise altogether. We said it would surprise folks if the S&P 500 went down 30% after a 50% rally off the October 2022 bottom. And what really happened is it went about 28% off the bottom and then down about 10% after that. And of course, now we've taken off into a whole new rally. So, basically this one didn't happen. I mean, that's all there is to it. But let's keep moving here. We said it would surprise folks if the Ukraine war envelops nearby countries and gets large numbers of NATO troops involved. That didn't really happen, but a whole new war started.
Right. Yeah. And that war is still going on. So it's not over.
Yeah.
And yeah, we have another one, big one. So
let's see. The next one we said was GameStop and AMC fall 90%. This is weird. GameStop kind of went sideways. It's down only 3.6% as we speak, but AMC indeed fell 84% so far this year. So, I'm going to say, hey, we got AMC right, but the GameStop half of that obviously was way wrong. Somebody thinks that's a real business. Next, what do we have? Oh, we said it would surprise folks if the Fed kept raising rates through the entire year, which they did not do. That surprise didn't happen.
Well, they did through the alternate meeting thing where they were raising every other meeting, and they stopped in the summer. So halfway.
Yeah.
I think the more important point there was that people were expecting inflation to crater totally this year, and I don't think we thought so. And so the Fed would keep raising rates. Now they did a little bit, and then now we're in the pause cycle.
Right. So the next one that we said, number 6, was it would surprise folks if the CPI did not fall below 5%, which of course it did. It's like 3 something. What is it? 3.1. So, I think we sort of, at least we kind of demonstrate that we know what the surprise would be. Like, it would surprise people if what happened, didn't happen. So we sort of got the trend right, but the surprise didn't happen.
Right. Maybe we should remind people that these are potential surprises, right? That
Right.
we're saying that this exercise
they're not
is
predictions.
Yeah, they're not predictions. They're things that maybe a lot of people aren't prepared for or thinking about or expect, and making sure that we are preparing and expecting these kind of things to happen.
All right. Number 7 last year we said was Bitcoin at new all-time highs. Didn't happen, but
Yeah, I would say there's a
kind of.
significant but there. Bitcoin's up 150% over the last year. So I remember saying this at the time, that I didn't think the sentiment around Bitcoin could get any worse at the end of last year. And that if you wanted to be a hodler, you should keep on hodling. And if you did that in Bitcoin and you had any, and you still have it, I think you're fairly happy about that. Now, I mean, we can talk about what may happen next with Bitcoin, but I think the point there was be prepared for a turnaround in something that was hated so much at the time.
Yeah. So didn't hit new all-time highs, but you're right. There's a big but there. So number 8 last year was mortgage rates below 4% or above 12%, like lots of volatility. Neither one of those things happened. It was probably kind of a dumb surprise, as was the next one, gold below $1,000 or above 5,000, like, lots of volatility. Crashing or soaring, some big event that would make either of those two take off. I didn't do any. I don't have any of those for this year.
All right.
So, and number 10 was just my kind of pet annual surprise, where I said S&P 500 down more than 20% in a single day, because supposedly markets are set up so that it physically cannot happen, and they'll shut down the exchange if the S&P 500 falls 20%. Maybe if this one doesn't happen in the next couple of years, I'll take it out, but I don't know.
Well, then it'll happen. So don't do that.
Yeah, that's right. That'll happen. And we'll say, remember when I used to say this could happen? NVIDIA may be America's top performing stock after more than doubling this year alone. But if you're holding NVIDIA or thinking of buying it to get a stake in the $7 trillion AI market, you're going to want to see Mark Chaikin's new AI prediction first. Mark is a regular on many major news outlets, from Fox Business to CNBC, and he built the stock indicator Wall Street uses to find winning stocks. His award-winning system flashed buy on Tesla before it climbed 335%, Moderna before it climbed 300%, and Riot Blockchain before it climbed 10,090%. It also found NVIDIA at the start of 2023 before its massive bull run. But right now, Mark is stepping forward to warn people to stay away from NVIDIA. My system has indicated that NVIDIA is no longer the best stock to buy to profit from AI, Mark says. In fact, it just flashed buy on a totally different AI stock. And today, he'd like to hand you the name and ticker symbol of his number one AI stock to buy right now. For a limited time, you can get this information for free at www.aifreenzyreport.com. Again, that's www.aifreenzyreport.com for a free copy of his new report. So that's 2023, and like I said, those last couple there I think are kind of dumb, so I won't do those anymore. All right, let's look ahead to 2024. And the first one I think that would probably surprise people for 2024 is if the Magnificent Seven just suck wind. As we speak, they're up 114% on average, those 7 stocks, right? Apple, Microsoft, Amazon, Alphabet, NVIDIA, Meta, Tesla. Up an average of 114% as we speak, and an average PE of 51 times earnings. Reminiscent in my mind of, Cisco and the other no-brainer kind of stocks that were priced for perfection in March of 2000, or even the Nifty 50 in the early 70s. Similar kind of vibe to me.
Yeah, I mean, it's they are up there in terms of returns and valuations. I think the thing I would prepare for is for them to suck wind, right? And what that means. What does that mean for the rest of the market? We talk about, just the headlines, like the S&P 500. We talk about how much of, on a cap weighted basis, how much those stocks make up of just the US benchmark. And so if they struggle at all, maybe it won't be great for the overall market and the sentiment out there in general, and could contribute
Might,
to,
yeah.
I don't know, just volatility and fear in the year ahead.
Right. Or I think what could happen and what I would expect is that if 2024 is a pretty good year in the stock market, these just don't perform anywhere near as well as they did. I mean, 3 of them, Nvidia, Meta, Tesla, all up triple digits this year. And Meta and Nvidia are like 193% for Meta, 241% for Nvidia. You know, like it's not just barely 100%. So maybe they don't do so well in 2024. But we've had this thing recently where within like 30 or 35 trading days, the equal weighted S&P went from a 52-week low to a 52-week high,
Right.
and the Russell 2000 did the same thing. So, maybe we just sort of rotate out of this stuff into something else.
Right. If you if
And
you
it's
believe that
yeah,
if you believe that the trends are going to keep going higher, it would
right.
logically make sense that the rest of the 493 and small caps and everything else would follow what the Magnificent Seven have already done, and the opportunity would be there rather than Nvidia and Tesla. And although Google, I still love Google, and it hasn't been up as much as or Alphabet hasn't been as up as much as the others, but um, yes, point taken. Like the run for these, has been great, and so what happens next?
Yeah, so as we speak, Apple up 52%, Microsoft up 56% for the year, and Google up 59, just about almost 60%. So they're the 3 laggards in the group. They only went up 50 or 60%. Amazon up 84%. So it's just like, look, if you got the trade right, good on you. You're awesome. If I got the trade right, I'm not saying I would necessarily sell them. I just wouldn't be buying anymore, and I'd be doing other things. And I think there's a lot of other things to do. So this kind of falls hard upon upon the next thing that I think would surprise the heck out of investors, and that is if the S&P 500 ended the year with a negative return in 2024. I think that'd be a pretty big surprise right now. I think we're back in bull mode.
Yeah, I think so too. I'm surprised by that one when you sent it to me myself. So
Yeah.
yeah, it's I mean, yeah, because I think even if you have a recession, how long will it be? How bad will it be? The optimist would say, oh, then there'll be time to recoup some losses through the end of the year. And, we're in a presidential election year. And, we can talk about the presidential election cycle with the markets where that fourth year tends to be not as great as the third year, but still positive. So there's different things you can
Mhm.
look at that, reasons why the return should be positive. But why couldn't be negative? I don't know. Yeah, it's certainly possible.
Sure. If you look at all the historical data, actually, our own Scott Garlis sent me some stuff this morning, and it's similar to the stuff I've quoted from the folks at Sentiment Trader before, and Scott did like the same kind of work, and they all say, when you've had a year like this, the logical thing is to expect another good year. Like historically, that's what happened, because most of the time, 2/3 of the time, the market goes up, and only 1/3 of the time does it go down. So, you know, I think that's it's in the zeitgeist. People are happy, they're optimistic, they're buying stocks. So that's what everybody expects. So if they get a negative return, they'll be like, Holy hell, didn't see that coming.
Which, by the way, I
All
think it's
right.
always wise to think about that stocks will have a negative return, right? Like,
Yeah.
especially if you're on a 1, 2 year, short time frame with what you want to do with that money. It's always smart to think about it. Yeah.
Yeah, exactly. It is smart to think about it. And our recent guest, Hari Krishnan, who has like spent his career kind of doing it and who does it regularly, says, yeah, I think it's kind of time. It's time to think about hedging. It's time to worry about it. And his trade that he liked was kind of being long. I think we were talking about NASDAQ or something, but just being long, but hedged. So yeah, you should think about it. Shouldn't obsess about it, but you should think about the possibility. And sometimes it's a good time to prepare for it. And, Hari said right now is a good time. I said, I think that's true as well. But, let's face it, being bearish most of the time is a bad idea. And right now, investors are in bull mode. So do what you will with that info. All right. You want to move on here?
Sure. We got next the number 3, the Federal Reserve cuts rates less than 2 times. So right now the most recent expectation is for the Fed to be cutting 3 times, 325 basis point cuts in 2024, which is what they wrote down, even though they're saying now that they aren't talking about rate cuts after putting out their most recent projections. So yeah, I think that would you're saying less than 2 times, so that would be once,
Right.
right? And
Hmm.
so just one little
Once
rate
or
cut
none.
or none. Yeah, I think that probably would surprise a lot of people at this point, given what we've seen market behavior recently. It seems like everything is reacting to the idea of multiple rate cuts in
Right.
2024. And so if that doesn't happen, yes, I think things will move around a bit.
It's funny because the surprise should be that the Fed would cut rates at all with unemployment still scraping like 40 some odd year lows and, housing actually doing pretty well. Housing starts, kind of went whoosh straight up 18% last month and, up 42% off the bottom not too long ago. And unemployment, housing, GDP above, the average of the past, whatever, decade or so or more was like 1.8, 1.9, something like that. And now we're in the 2.5-ish range. And they're talking about cutting, which they usually wait for the weakness in labor or something to show up. And I don't know what they're looking at when they're saying cutting. The only thing I've heard is that, well, there's a lagging effect to all of this monetary policy. So we want to start cutting before we get the policy rate down to, before inflation is 2% and before, um, I guess, things start breaking in the economy is maybe the underlying message.
Yeah. Yeah, he said that before, like a couple months ago, that we will start cutting before inflation gets to 2%. So I think that's why people are expecting that now because he said it. Now, whether that's true or not, I don't know. Maybe there is a lot of overreacting happening. And like you said, the unemployment's still, trended down last month. It's been ticking ever so slightly higher throughout the year, but still nothing horrible yet.
Yeah.
So yeah, maybe everybody is getting ahead of themselves, and we're just in pause territory for a while longer. Or like you said with the housing, like housing prices having gone down. They've been going up, on average nationally. So it's like that's it's hard to knock off the inflation, the last part of the high inflation with that happening. So
Hmm. I mean, yeah, I agree. It's just it's hard to it's hard it's hard to see this. But we've been given the explanation and we'll see how it plays out. So surprise number 4 is gold hits $3,000. Now I said I was going to stop doing the crazy stuff where I said, gold either below 1,000 or above 5,000, and
3,000 is good. I think that's a in between. That's actually right in between 1,000 and 5,000, Dan. So we're that's not crazy at all. If that's the target, right? That like from a technical perspective, I've seen a lot of people who have been talking about.
they are. And we're just above 2,000. So that would be a big move though. 50%. in gold is a big move. And, the gold stocks would just be on fire, absolutely on fire. But I guess the real point is to talk about what would cause that. And it's funny because I don't really know. I just tell people, well, it's a good idea to hold some gold because you don't know what's going to happen. Maybe the US would get much more deeply involved in either of these two wars going on than we expect them to, much faster than we ever expected. There could be some shenanigans with the currency, if they start, if they really crank up the CBDC rhetoric and then actually begin to, well, they've begun to implement it, right? But it's in a very small way and we don't see it mostly. But if it becomes, if they say we're going to roll out CBDC to the whole, central bank digital currency to the whole country, and that's what the US dollar is going to be from now on, that would be chaotic, I think. People would hate it and they would buy gold and Bitcoin like crazy.
Yeah, yes, there for sure, and there's plenty of reasons just to expect chaos in general in the year ahead. So, and gold is the chaos hedge, as some people like to say. So,
Yeah.
I don't know if you saw, but people have been buying up all the gold bars at Costco and Walmart recently too. As many
Yep.
as they can. It's like Black Friday every day. It's gold every day. So that tells you about where people's heads are at too.
Yeah, it's strange. It's strange that story just struck me as so odd. I'm not even sure why. It's just that, like, of all the places, when I buy gold, I don't say, "Let's pick some up at Costco." And if I saw it at Costco, I'd think, "Well, the spreads are probably too wide here. That's probably not a great deal. I should go to the reliable folks that I normally go to locally and just, do it that way." But yeah, I found that story very odd. And I don't know, I mean, what is your sense that that is really, you said that if that's where people's heads are at, but, like, I never got the sense that it was a panicky thing. You know what I'm saying?
I think, I really think, I think that people are just, fearful of what's going to happen next this year. I think with elections and the government in general. I mean, all things we've
Mhm.
talked about, just who knows what's going to come next. And maybe there's something that we don't know about, a push, some groundswell of, we have some idea of it, but maybe it's way more powerful than we think. It's, and just collectively, each individual, these are individuals just buying gold bars at Costco. So it's in Walmart. So it's, I don't know. Yeah, I think it's reflective of just the mood of a lot of people in the country.
Yeah, it would certainly cause a lot of people to worry a lot, if no matter who gets elected, the other side doesn't accept the results. I think the odds of that happening are higher than they've ever been in my lifetime. And, that could scare you a little bit, right? People are watching these movies about civil war and, leaving the world behind and all that stuff. And then, then they might see this other person get elected from whatever side and think that they did it illegally. Um, people could you're right, people could be, I see the mindset now. So who
Yeah, it's.
knows? They
I mean,
might.
nobody thought 4 years ago that, or 3 years ago that, that January 6th would happen, and so,
Mhm.
and we've seen all kinds of stuff fall out from that. So, if
Yeah.
something like this happens again,
Mhm.
people will want to be owning gold. I think so.
I think
Yeah.
so. Alright, so let's move on to number 5 then. Maybe you should read this one since the Bitcoin surprise was really came from you last year.
Sure. This one is Bitcoin falls 50% or more.
It would surprise the hell out of me. I mean, I know
I
that.
think I just said on another episode, or I did just say on a earlier episode that it wouldn't surprise me if Bitcoin fell 40 or 50% after 150% gain this year, because
Right.
it still trades so volatile and wildly. Um,
Okay, so
I
maybe
think
the surprise would be more than 50%.
yeah, yeah, yeah. Oh yeah, more than 50%. I mean, yeah, it could still fall 50% and be above the lows from last year. So that's how quick this thing moves. I think if it does fall 50%, that would be, for the reasons I explained or talked about the last time, that would be a great buy for me, a buy at that point, given the longer term patterns and trends in play for Bitcoin, I think, as a speculation again. But yeah, I think it would surprise um, people at this point, after getting past all what looked like what has been a low last year, and all the SBF, FTX nonsense, and the SEC going
Mhm.
after cryptos. It would probably just surprise a lot of people. So yes, but it could very well happen for reasons we have no idea about right now. So if that covers it all, I think that covers all the bases there.
Yeah. Yeah, it does. So I don't know what else to say about Bitcoin except that the usual stuff, like, I still don't see it behaving anything like a currency. I know you've made it clear that, it's sort of a speculation. It's almost like an option on monetary issues or something, or even monetary issues, or tech stock speculation or something like that. But I still, my head is stuck in the white paper. My head is stuck in the reason they created it, which was to be able to transact outside an unreliable financial system filled with middlemen who are levered up and could collapse any minute the way they did in 2008. And I just don't see that happening. To me, it's still like, as you said, it's a speculative asset, and if you want to transact in it, it's just dollars, right? You just buy it with dollars, and you convert back to dollars after you do whatever transaction you do. And by the time that's not true anymore, if Bitcoin really does become a currency, or a gold-like store of value, with monetary characteristics, I'll look stupid probably, because by then it'll be, a million or 2 million bucks or something, and then it'll just stay there and go sideways forever and be a reliable store of value.
Right.
Uh,
Yeah, I would say,
anyway.
I just one more thing on that. I would say it's more Bitcoin itself, I think, is more speculative than not. But there's
Mhm,
I mean, if you look at like Ethereum and the other networks and those kind of things
mhm.
that our colleague Eric Wade researches and talks about all these things in crypto capital, there's very good use cases for specific cryptocurrencies as well. I'm not saying that,
Yep.
but I'm just saying Bitcoin itself, the most popular one, has, like what you said, it's kind of like that anti-monetary Fed policy kind of. It's got that
Oh,
going with
yeah.
it too, which lends itself to some speculation, right? Because the Fed is still around and the system
Right.
is still around, and so that's all I'm saying there.
Yeah, no, I hear you, and if we get the conditions where gold would hit 3,000, Bitcoin is I think Bitcoin is 6 figures easy,
Yeah,
easy, and maybe the
yep,
first number is not a 1, you know, under
yeah,
those
that would be
conditions.
conservative, I think too. Yeah,
Yeah. All right. Number 6 is if the personal consumption expenditures index comes in around 4% for most of the year. Of course, this is the personal consumption expenditures index, being an inflation gauge that we know the Federal Reserve looks at much more so than the consumer price index, the CPI. And as we speak, PCE is not, it hasn't fallen as steeply as the CPI, which fell from like 9.1% June of 2022 to around 3.1% now. And PCE, that peaked at around 5.6% in February of 2022, and it's been much shallower decline, and now it's 3.5%. So it's below 4%, and it's sort of picked up downside momentum. It looks, if you look at the chart, in the past few months here, but still, it's just not falling as steeply, and we know that's what the Fed looks at. So I think it would really surprise people if it kind of, stayed here or went higher, hung around 4%, or even got above 4%, and then maybe we'd see more of that, damage or whatever it is anybody's looking for, and then maybe we'd see, some cutting going on at the Fed. or that, it would be more justified because now we're talking about, low unemployment, good GDP growth, good housing market, et cetera, et cetera. And if that continue, if things are as good as they look, you know, interest rate cuts could just melt the market straight up, which it's done in the past couple weeks here, but could really just continue and be another crazy speculative year if the cuts are kind of unwarranted by the economic data. So yeah, I think it would surprise people at this point if inflation were more persistent and PCE came in around 4% for most of the year, or even for part of the year. I mean, at this point, if it ever sees 4% again, right?
Right. I would think everybody's obsessed with 2%. Nobody's thinking about it going the other way.
Yep.
I would think wouldn't you if inflation then rebounds to in or around 4%, like that would cause the Fed to maybe hike rates again, no? And then cause more
Could.
damage, uh, down the road, potentially. Like maybe we're in that, like what you said before, that we're in a rate hiking cycle with small cuts within it. We're still in that uptrend of rates generally.
Yeah, I'm sorry, I misspoke. I said cut, didn't I? I should have said hike.
Okay, yeah, no,
But
that makes more. That's what I
yeah,
thought you were talking about.
yeah,
And so,
sure,
um,
sure.
yeah, they would be hiking at that point, which would then cause all that everything you said. So, um,
Hmm.
yeah, that would that would certainly surprise people, and it's certainly possible because as we've seen, higher inflation has stuck around longer than a lot of people thought, and there's tons of risks for it to rebound again. Globally, I think we're seeing that right now, even just with like what's going on in the Red Sea and oil prices, and going up a little bit. So
Yeah. All right. I think the next one, number 7, well, I'll just say it. I won't try to explain myself. I think it would surprise people if Donald Trump is elected president in a landslide victory, or even at all at this point. I personally can't imagine it.
you can't. I see. I'm imagining it more and more every day. So
Right.
um,
Yeah. I mean, I think I hear what you're hearing in the news, and I hear, he plays to his base. They're in love with him. Joe Biden's popularity in whatever polls that you look at is not good, and so no other Republican candidate is polling nearly as well as Donald Trump. But I think here's what I think about Donald Trump. He was absolutely perfectly aligned with the moment in 2016. And he said all the right things. And he went to all the places where Hillary Clinton thought she had it locked up, and he took them away from her, and he won. And he said these things about making America great again and lowering taxes and all kinds of things. And it sounded great. But, in the end, I don't think he behaved like he didn't clean up any swamps. He didn't clean up the swamp. And my personal opinion about our presidents is that there's really no meaningful difference between Joe Biden, Donald Trump, Barack Obama, George Bush, Clinton, first Bush, whatever, Reagan, Carter, Ford, Nixon, go back as far as you want. And there's no meaningful difference between them. If you can get elected, it's because you're doing and saying the things that someone needs to do and say at a certain moment to get elected. It's not because you're really would be good at the job of president. And I think those things tend to all sound kind of the same, even if they sound very different. They all sound like, I'm going to use the government's awesome power. I'm going to use the awesome power of the most powerful government in the world in a way that you like. And if you say that message the right way, you get elected. And tell stories about America that people want to hear at a given moment, making America great again in 2016. But I think his moment has passed, and I don't think his base really understands that. They still want to hang on to the vibe that he had in 2016. Just my 2 cents. I have no idea what's going to actually happen.
yeah, no, it's interesting. Like you said, I keep seeing the polls, and I think it was Chris Christie during one of the debates, one of the Republican debates, called Donald Trump like Voldemort from Harry Potter. Like you should not say his name because everybody debating on stage is, essentially for second place in the Republican Party. And, if we have some economic troubles ahead of November, typically that's not good for the sitting president. So, if Trump is the Republican nominee, I don't see why he couldn't win. But given all of the, all of the sensitive things that around him, just as a character and a person, all that aside, I'm just saying from the setup of it, I'm not getting it out. But I think the economic point, is, let's not forget that during COVID, what the government did with the amount of spending that was approved through Congress when Trump was president, right? First. And then when Biden became president, it was the same thing, right? It just continued. And that was probably the really overkill in 2021 and 2022. But like you said, everybody behaves the same to be the most popular at any given moment. And it's how we've gotten to this point. And so yeah, I who knows? I am so sick of politics at this point. Somebody else needs to emerge who just is somebody else. I don't know who they are. And I don't think anybody knows who they are. So it's
all right.
Yeah, that's all I got to say about that.
So Corey, let me ask you, man, what if this would not surprise you, feel free to sort of rewrite the surprise here. What politically would surprise you? Or maybe there's nothing in particular. Maybe nothing would surprise you at this point, and that really is the point.
Yeah, I guess. Yeah, that might be the point. I'm not. It's. I would be surprised by a landslide, as you put it. I would be surprised by that. So,
yeah,
on the headline, I would be surprised by that. Yeah, I'd be surprised if an independent one, right? That never happens. So
yep.
That would be something different and probably welcomed. If a moderate candidate won, I think that would be pretty surprising at this point.
All right. I think we've firmly established that Dan knows nothing about politics and Corey doesn't want to hear about it anymore. So let's go to number 8. Surprise number number 8 for 2024 would be a nasty recession begins, is how I phrased it. And this, of course, would maybe I'll get better at writing surprises, because you could say that this is with number 2, that the S&P 500 ends the year with a negative return, which would, go along with a recession, right? And if the Fed does cut rates, and if the economy behaves in such a way that justifies cutting rates, we would expect might be a recession, and that the S&P 500 might not do so well, because it tends not to do so well during recessions. But this one, I don't know. I feel like talking about a recession, just saying the word recession just made my IQ go down.
That is funny. Yeah, it's yeah. I think I was looking at what the Fed projections lately, and people are expecting the rate cuts because I think they expect a recession with higher unemployment, which makes some sense. And I do think but it might be worse than what those projections show right now, because I was looking at some research, and the Fed has historically underestimated where employment goes in a rate hiking cycle by an average of 2.5%, which, if that happens, would put the unemployment rate around 7%. So would that surprise people? I think so. And then in that scenario, you're talking about rate cuts and, all the same stories of the past of, devaluing the dollar. And then we're seeing gold go up and Bitcoin and all the things. So, yeah, I would, and, depending how bad or long it goes, yes, a negative return for stocks. So, or depending on how quick the government responds, not a negative return, and all those things. So, Yeah, I would be prepared for it. Doesn't mean you need to be all out of it, stocks and everything right now, but um, certainly something to think about.
Yeah, it is something to think about, and it's nothing that you should try to predict.
Right.
Yeah,
Anybody who predicted it last year was not right.
right.
If anything, that we already had a recession in what was it, in early 2021 with the two negative GDPs, which wasn't acknowledged by the powers that be. So
And in a way, saying that it would surprise folks that a nasty recession would begin, um, it's kind of an odd thing to say right now because, the Fed's penciling in 3 rate cuts, which, 325 basis point cuts maybe is not a very big deal. But if they do any cutting beyond that, I mean, the market is pricing in. At one point, the market recently, within the past couple days, I saw um, in a post from the Daily Shot, the macro chart guy, they were saying the market at that moment was pricing in like 140 basis points of cuts, right? So that's like there's something going on, and we're trying to stimulate the economy. I mean, that's more serious. And if if that sort of market based prediction, whatever you want to call it, is right, then we could see a recession. We could see the Fed cutting at least 3 times, um, and everything that they're saying right now would make a little more sense. The only thing that wouldn't make sense is that the market's on fire, right?
right.
Anyway,
I think you hit
all
on it
right.
right there with yeah.
Oh, okay. What hit on it for you right there?
I think when you're saying a lot of the only thing that wouldn't make sense right now is the way stocks are performing, and um, yeah, it's if the recession that's why I keep writing as much as I can. If the when the rate cuts start happening, that is not good for stocks. Like that would
Generally
it's
speaking,
history has
yeah.
shown it. Yeah, generally speaking, every single time, especially when valuations are expensive. So which they are now. Like and for those
Right.
Magnificent Seven. So yeah.
All right. Let's go into number 9 here, which is if the 10-year yields. I said if the 10-year yield stays above 4% would be the surprise, but at this point, if it goes back above 4%, because it's 3.9 as we speak, so that would 4% at all, and then staying above 4%, I think would surprise lots of folks, and it would probably be. I'm going to say it would be roughly neutral to not so great for market valuations, meaning stocks would stay about where they are or get cheaper, something like that.
Yeah. Yeah. I don't have too much to add there other than um, if they went back up to 5, that would be
Oh, yeah.
a different story.
5 would be risk off. We're in a bear market again.
Yeah.
Absolutely.
Yeah.
Yeah. 5 would be a nasty moment. I mean, we bounced off 5 and off the bottom in the stock market. Like that's what did it, right? Rates turned around at 5% and the market turned around at the bottom there. So yeah, 5, woof, ouch. NVIDIA may be America's top performing stock after more than doubling this year alone. But if you're holding NVIDIA or thinking of buying it to get a stake in the $7 trillion AI market, you're going to want to see Mark Chaikin's new AI prediction first. Mark is a regular on many major news outlets from Fox Business to CNBC, and he built the stock indicator Wall Street uses to find winning stocks. His award winning system flashed buy on Tesla before it climbed 335%, Moderna before it climbed 300%, and Riot Blockchain before it climbed 10,090%. It also found NVIDIA at the start of 2023 before its massive bull run. But right now, Mark is stepping forward to warn people to stay away from NVIDIA. My system has indicated that NVIDIA is no longer the best stock to buy to profit from AI, Mark says. In fact, it just flashed by on a totally different AI stock. And today, he'd like to hand you the name and ticker symbol of his number one AI stock to buy right now. For a limited time, you can get this information for free at www.aifrenzyreport.com. Again, That's www.aifrenzyreport.com for a free copy of his new report. All right, I guess we're ready for Dan's pet surprise number 10. It's the same as last year. I think it's the same as the year before. So, third year in a row at least. And that is, it would surprise everybody if the S&P 500 dropped more than 20% in a single day. For any new listeners, I should explain this. The New York Stock Exchange, they have what is called circuit breakers. So if the S&P 500 drops 7% in one session, they halt trading for 15 minutes so that everybody can sort of collect themselves and just calm down a little bit and to allow some of the order activity to play out. And then they continue trading. Then when that same day the market's down, I think it's 13%. Yeah, 13%. Same thing. 15-minute trading halt. Everybody collects themselves, lets the order activity kind of sort itself out for 15 minutes. And then if on that same day the S&P 500 drops 20%, they close the market. So technically speaking, the way it's set up, the market can't drop more than 20% in a single day. But as a pure philosophical issue, like if you are a floor trader or you're inside that industry in a way that you understand this 10 times, the operation, the daily operation of this 10 times better than I do, I hear you. I'm not arguing with you. I'm not saying I understand the mechanics better than you. I'm saying that philosophically, I don't think humans control markets. I think humans are in markets the way fish are in water, and we don't control the wind or the tide or the currents or the temperature or anything about the water. And we influence it because it's made up of our activity. So it's not exactly like fish in water, but it's enough like it. And we don't control it nearly as much as we think we do. It could easily happen that investors get just scared to death the way they were in March of 2020 or on October 19, 1987, and that the market could indeed fall more than 20% before they close it down. And that would surprise the heck out of everybody, except for the folks who took Hari Krishnan's advice to hedge.
Yeah. By its very nature, that would mean people are surprised, right? Everybody's panicking and selling everything. And, you're saying 20% in the markets, but then what about individual stocks too? It could be different things happening with those. And
Right.
yeah, the last time we really saw the circuit breakers was March 2020. It was a couple days in a row and a couple times per day. I remember tracking all of that. And yeah, the circuit breakers work then, but what if they don't?
Right.
What if they don't? You never know. So
You don't. And it would admittedly be, a terrifying moment. And you're right. It's the definition of surprise, that kind of thing. But, it may not be a perfect analogy, but, you've seen this happen in the very biggest cap stocks like Apple and Meta and even Microsoft. If you look among the top 10 one-day market cap losses, like hundreds of billions of market cap, just whoosh, gone in an instant, not just in one day, but in an instant. That means there were no buyers between like at one price and then all the way 20% down to another price. Zero bids in between there, and the price just collapsed right down to that other price. So I'm saying that can happen for the market as a whole. And if it happens, when the market's already down, whatever, 15% or something, and it's, 5 minutes or 2 minutes till the close, and then wham, you're getting no bids down another 10%. There you are. So
Dan, let me ask you, if somebody's worried about that happening, what would you say to them? What would you recommend?
well, I've consistently told people to hold plenty of cash. I've consistently, well, I don't know about consistently, but I frequently told people that it's a good idea at various moments to hedge, to buy some put options. And I agree with our recent guest, Hari Krishnan, that now is one of those times. And he was talking about going out 2 years down maybe 15% on the S&P. And, if you did that and this 10th surprise happened, you'd make a ton of money on that hedge and you'd be able to put it to work. And sure, I mean, that moment, you'd probably get the V bottom of all V, with the skinniest V bottom you ever saw in your life at that moment, right? So, yeah, I'd be looking to, I'd be looking around and seeing what was getting really super cheap and attractive at that point. Because when it happened in 1987, that was a decent moment. I think that's when around that time is when Warren Buffett started buying Coke, as if I'm not mistaken. So, yeah, there'd be things to do and things to do beforehand to prepare for it.
Very good. Yeah, it was the same thing in March 2020. Was once the panic stopped in the middle of March,
Mhm.
that was the time to buy. Yeah.
That's right. Those circuit breaker days came toward the end of the episode, like, the really big down days were toward the end of it, and that was the time to buy. That was right around the time when Porter came out, and I remember he did a little video presentation with, uh, gosh, why can't I think of the guy's name? Um, but he did a
Austin.
little
Yeah.
video. Yeah, Austin. Sorry, Austin Root. I'm so sorry that I couldn't remember your name. Um, Porter and Austin did a video presentation, and he was saying, I think you should buy great companies now and hold on to them. This is, this sort of thing will pass. Blah blah blah. And he was right. Almost to the day, as I recall. It was a really good call.
Yep.
So, I have no reason to believe that wouldn't happen again.
One more quick
That
thing on that was that part in March when the bottom happened. That happened after a Fed emergency rate cut, right? The cut happened to zero, and then the market kept falling after that. So again, the rate cuts are not
oh right.
the fix. That's like the signal things are going wrong. To get back to one of the things we were talking about before.
Right. And to be fair, though, I mean, low and falling rates since 2009 have kind of taught people to think this way and to behave this way, to be really fair, right? Because they tried to hike, they got from 0 to 2.5% starting in like 2015, and they got up to like 2.5% in 2018. And, the September to December market performance was like minus 20% on the S&P, wasn't it? And in the fall of 2018, and I think they wound up cutting in July of 2019. So, and of course, from 2019 to right up, a month before the March 2020 panic, that was those were new highs in February of 2020. So I understand why people think this way. They think, rate cuts are good. They stimulate the market. They stimulate the economy, whatever. Economy or not, they stimulate the market, right? So
Yeah.
they're good. But, as you've pointed out, um, I believe in more detail more often than I have. Historically, not when they, especially when they start cutting, it's like hold on to your hats, right? It's not necessarily good.
Right. History shows. Maybe history will be wrong, but I'm
Right.
a believer.
Yeah. Well, we've certainly had a weird time since the pandemic, right? We get, the pandemic shut everything down and then everything opened back up. So it's hard in real time to look at it and just say, "Oh, this is all because of the pandemic. Don't worry, everything's going to be fine." Um, I'm not saying everything is going to be fine. I think, that the extreme measures taken and the extreme low in interest rates that prevailed for many years before the pandemic, I think those things program people to think a certain way, and I think that way is probably not quite right. And I think it also inspired a lot of misallocated capital, and it, just put people of a certain mind to believe all kinds of things about markets that aren't really true. And, those beliefs usually accompany speculative peaks, and those speculative peaks are usually followed by pretty poor performance. And when they're really, really bad, when they're mega bubbles like 1929 or the NASDAQ in 2000 or the Japanese market in 1989, December 1989, then they're followed by horrendously bad sideways markets for decades. So, decade and a half, 2 decades, 3, 4, whatever. So, that's where my head is at, man. Um,
Over in Japan, that's where your head's at. Yeah.
well, sort of, yeah.
Sort of, yeah. Very good. Well said.
Over,
Yeah. No,
yeah,
we're still like, let's not underestimate still all the effects of all of that stimulus, and we're still
yep,
not out of that story. I mean, it's maybe not for another 5-10 years it might not be. So
Right.
it's still happening.
Right. And then, maybe 10 years from now, we could wind up looking back and saying, wow, that was quite a big speed bump, but, in the end, it was okay. Right? But I don't predict this, but I do think the risk is high that we do get a difficult next several years, and probably even if we get new highs in stocks, there's a precedent, in the 60s and that whole sideways period, late 60s to early 80s, for stocks making a new high and then still going sideways again for several years. So a new high, I don't think gets us out of the woods necessarily. I think you should be prepared for things to be very different and for different assets to perform better than what performed better over the last, 10 years or so before 2022. Period. Just right there. All right. I think I feel like we've come a long way here just in the course of this one episode. It just, when you cover all these different surprises and things and entertain all these scenarios, it feels like we've been talking for 3 hours. I hope it doesn't feel that way to the listener.
It does. Yeah. There's a lot. I feel like I've just prepared for a whole year, which I guess we just did with all the different, we covered a
Yeah.
lot there with different asset classes and whatnot. And we will see what happens. I mean, it
We
comes
will.
down to like your timelines, I think, for at least this is what I try to keep in mind. Your timelines for whatever investment you have, what you think's going to happen or what's not, or what you can know what's going to happen or not happen, which is mostly you can't know. And just try to stick to your goals and your plan and your time horizon and how much you can afford to put in the market at any given time or on any given position. We don't know what's going to happen here, but we will find out.
Right. We don't know what's going to happen, but there's no reason, I think to your point, there's no reason to abandon your search for, good businesses that you intend to put into your account or your 401k or whatever and hold for the long term. Like with all the stuff we talk about, there's no reason to stop doing that because a really great business is going to continue to be a really great business. I think the Magnificent Seven are fantastic businesses. I just don't think they're priced for interesting. They're not priced for good performance over the next year or 3, put it that way. But, if they're higher 10 years from now, will anybody be surprised? I don't think so. So, yeah, we continue to invest from the bottom up and worry from the top down. All right. Well, that was a lot of fun. And I hope you enjoyed this episode where we looked at our top 10 potential surprises for 2024 as much as we really did. We do provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody else who might like it, tell them to check it out on their podcast app or at investorhour.com, please. And also, do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @investor_hour. Have a guest you want us to interview? Drop us a note at feedback@investorhour.com or call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my co-host, Corey McLaughlin, until next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.